Okay, good afternoon, everybody. Welcome to today's workshop. Sponsored by First Bank, and it's a securing capital. Brad, if you can jump to the next slide, I'll tell everybody about just a couple of housekeeping items here. The first is that just ask that the participants stay muted, and you can definitely ask questions. Enter them either into the chat or the Q&A box. And I'll be keeping an eye on that, and we'll get to them throughout the presentation. At the end, we're going to send out the slide deck here, and then also we'll get a recording of this. Give me a few days. We'll get that up on the YouTube website and give you a link to that. And also at the very end, you're also, I think sometime tomorrow, you'll get a questionnaire. If you have some time, we appreciate your feedback. If you could just take a couple moments to fill that out. If we could jump to the next slide, Brad, we'll just a little bit about SCORE. You guys are probably familiar because you came across the workshop through either through our website or through one of our promotions. But if you're not, we're actually 100% volunteer-based, a nonprofit organization. We're a resource partner for the SBA. And really what we do, we're known for two things. The first is one-on-one mentoring. And what happens there is you're able to team up with one of the mentors on the team. And they're typically either somebody that has a lot of experience as, let's say, an executive in a larger business, or small business owners themselves that are now giving back to the community. And what we try to do is just to work through whatever issues you're experiencing with your business, or if you're looking to start a business, help you with things like a business plan design. And the other main thing that we really try to do is provide the guidance to make sure you guys have the information and the resources that you need. So we're there, and if you're interested, that's what we have there, the Piedmont.score.org. That's probably the best way to find us. You can you'll see a link there to view our other workshops that are coming up, and you'll also see the link to request a mentor. And the next slide, Brad. Yeah, so just at this point, I'll actually introduce Brad Cantrell, and he's, like I said before, he's with First Bank. And Brad has just recently came over to First Bank as the SBA Business Development Officer, has 20 years of experience, various types of small business, SBA lending. Has a master's degree in applied economics from Clemson, and you can see the rest of the bio there. But very well versed in small business finance, and we're just fortunate to have him here today to help us understand a little bit more about securing capital. So at this point, I'm going to turn everything over to Brad. I'll be here in the background, guys. If you have any questions, throw them into the Q&A, and we'll get to them as we can.
Thank you, Jerry. First of all, I'd like to thank Jerry and SCORE for having me here today. I've always enjoyed doing these types of events. And for all of you guys out there in front of your computers, thanks to you for taking part of your lunch break or whatever slice of your day you are to take advantage of the resources that SCORE offers. I've got some slides and a presentation to go through, but this works much better, and I think is a benefit to everybody if you ask questions. Please don't hesitate to ask a question. If you're thinking it, chances are there's somebody else on this call that's thinking about it as well. So please don't hesitate to ask. We'll get right into it. First of all, what is capital? And I've got two definitions up here in front of you. And today we're really going to focus on bullet point number 2. Capital is most often associated with cash that is being put to use for productive purposes. Well, why do you need it? I think the most obvious uses of capital, of course, are asset purchases, purchasing equipment, inventory, real estate. But you need it to cover operating expenses. You got to keep the lights on. You got to pay your employees, insurance, everything else that comes with it. Small businesses definitely want to grow, and growth is great. but it's expensive. So you need capital to fund the growth. For example, if you're a manufacturing company, you may get an order to produce whatever product you're producing. But when you get that purchase order, you have to buy raw materials. You've got to continue paying your labor. You've got to pay your utilities. And then you got to ship the product to your customer. And your customer may have some terms where they pay on 30 to 60 days. So to bridge that gap, you need capital. So that's another common use that is caused by growth. Well, where do you get capital from? I've listed some common sources and the most typical sources. The first, if you've got the rich uncle, congratulations. Most people don't have that. So if you've got a family member that you can tap for some resources, great. You can do that. It might make Thanksgiving a little uncomfortable if you don't pay them back. So, nothing's free. Personal savings, that's another good area. If you have it, that of course that's something people use. And personal debt. One way that people accomplish capital needs through personal debt is a home equity line of credit. And if your capital needs are small and you have equity in your home, I recommend this for a lot of people. It's pretty much a very inefficient and inexpensive way to tap into capital. So home equity line is great. Private equity is another source. Typically here, the rates are going to be a little bit higher. And many times the provider of the equity is going to want some ownership stake in your business. So dilution of ownership is going to happen. Then another common source is bank funding. First, you have conventional commercial lending and you have SBA lending. Most people will use a combination of all of the above or some of the above to get the capital needs for their business. And where your business is at in its growth cycle, and how mature it is, and the timing of the request will determine which of these avenues are available. For example, if you have a mature business and you have a history and you can provide several years of tax returns and you have good cash flow, conventional commercial lending might be a good source for you. If you're a new business or a quickly growing business, commercial lending, traditional commercial lending may not be a good source, and you might have SBA lending or private equity or some of the other sources you might have to lean on. So the first type of bank financing I mentioned was traditional commercial lending, and we'll just kind of jump into that real quick. In the first point, bank regulations shape policies. What I mean by that is that, the regulators, the banks deal with the same regulators, and the regulations that are provided to the banks is basically the banks are required to stay within certain lending parameters. So all banks are playing by the same set of rules. Banks want to see historical performance. They don't want to see, there's not much concern about what's happening in the future. There are loan to value requirements, and loan to value is just the debt divided by the value of typically it's real estate. So they're going to look at either the appraised value or purchase price, and they usually lean on the lower of those two. So a lot of times you're looking at loan to value in the 80 to 85% range, which means you're going to have to put in, 20 to 15% of your equity into the purchase of that asset. In terms, that traditionally you're going to see, they might, on real estate, you might get an amortization of 15 to 20 years. And then you're going to look at a loan term of maybe 5 to 7, where you're going to have a balloon that terms out. If it's an unsecured loan, the maximum term you're going to see is 3 years. Different asset classes have different terms that are allowed by credit policies. SBA 7A lending, another type of bank financing. Some of the characteristics include it's for profit organizations only. It's got to be owner occupied. It can't be investment. The maximum loan amounts are $5 million. And here you can look forward instead of just looking backwards. So we can use projections for underwriting. So if you're a new business or you're a growing business, we can kind of look forward at those projections. We just have to have some support for, how are you going to achieve these financial benchmarks. With SBA lending, there's lower equity requirements. Typically, you're going to be required to put 10% of the total project in. And total project's important to notice because we consider basically anything the business needs to be successful. So that would be, and to get the deal closed. So if you need to purchase real estate, equipment, maybe some working capital, closing costs, all of that's rolled into kind of one ball. And we call that the project. And your equity requirement would be 10% of that total amount. SBA lending will allow for longer terms, 25 years on real estate, the working capital inventory and leasehold improvement funds are 10 years. And then some equipment can go up to 15 years, depending on the useful life. And then if it's if the loan is going to be funding real estate, working capital, equipment, and various other uses, we can look at blended terms. But if 51% or more of the loan funds are used for real estate purchase, we can take the whole loan out to 25 years. So of course, the longer terms provide some payment flexibility and helps improve cash flow.
Greg, can I ask a question?
Sure.
We've got the loan amounts up to the 5 million. What about minimums? What would the smallest loan look like?
Sure. So a traditional SBA 7A 350 is usually the minimum. However, there's an SBA Express product that will go down to 50,000. So
yeah.
Wow. So it will go to it goes to 50,000. It's it's a similar to the regular 7A loan, but just a little bit more streamlined process, and it's kind of set up for smaller deals.
Yeah, that's a really I think interesting option for a lot of the smaller score clients that would probably be just somewhere. I would imagine a lot of them are going to be in that 50 to 100 range. So all right, well that's good to know. Thank you.
And also a good point to bring up. There's some other organizations that are funded through grants, and they do well in the small loan space. Here in the upstate, Community Works is one. Their sweet spot is kind of anything under 100,000. And then another one in the state is the Climb Fund. They're out of Charleston, but they lend statewide. So if anybody ever has, a need that's smaller, feel free to reach out, and I'm happy to make a connection.
Oh, excellent. Did you say Climb? Is it CLINE or
Climb, CLIMB?
Climb. Got you. Okay, I wasn't aware of that one. Thank you.
Yeah, so if anybody wants, I'm happy to make some introductions. There's some good resources out there that most people aren't aware of.
Okay, thank you.
Yep. So I've mentioned SBA a good bit in the last few minutes, but what is it? It stands for Small Business Administration. It is a division of the federal government, and it was created in 1953. Essentially, it's there to help small businesses obtain capital that maybe normally wouldn't be able to through traditional means. Kind of the name of the game is capital preservation and cash flow enhancement. So here's some other characteristics about SBA lending. And I think the first bullet point is important. So the bank is in 7A lending, the SBA is not a lender. It's not the SBA's money, it's the bank's money. So what the SBA does is they come to a bank and they say, bank, if you'll do some things that maybe take some risk you wouldn't normally take and kind of lend outside your credit policy, we'll essentially provide an insurance policy and cover if you ever incur a loss, we'll cover some of the losses for you. So that kind of allows the bank to step out and take a little bit more risk than normally it would. We talked about the second bullet point already, but and is probably obvious, but not everybody can qualify for an SBA loan. Certain criteria must be met. We mentioned that it's got to be for profit, got to be owner occupied. Most industries qualify. There are some that do not, but for the most part, most industries do qualify. Some of the advantages of a SBA loan, again, we've talked about the longer term financing, but there's no balloon or call. And we touched on that earlier in that traditional commercial loans, you're looking at, a 5 or 7 year loan that matures, and at maturity, you're either, it's due in full. So you either have to, you have to pay it off or refinance the loan. It's typically understood that the bank will refinance the loan at market terms, but it's not guaranteed. During the 07-08 recession, I remember seeing some banks that decided that they didn't want to be in certain industries anymore. So when loans came due, they just said, we're not going to renew it. You need to find a way to pay us off. So with an SBA loan, that's not an option. As long as you pay on time, that loan is yours for as long as you want it. Here's just some kind of examples of how the cash injection works, for each type of loan. Debt refinances are popular uses of SBA funds. A lot of times I'll see where a business will go, they'll need some equipment, and maybe they get with the equipment vendor, and the equipment vendor has a finance arm, and the business owner doesn't have the time or take the time to shop out there and see what's fair. And the vendor may give, high rates like 18% in a short repayment period, maybe 4 to 5 years. So in those situations, a lot of times we're able to go in there and stretch out the payment, lower the rate, and offer some significant savings. So, and in those situations where we're just refinancing debt, no cash injection is required. It's just a straight refinance. In a real estate purchase, again, typically is 10% of the total project, to include closing costs. There are certain situations where if it's a real estate purchase and the borrower's been renting a property and the rent they've been paying is almost equal to the mortgage payment, and we can call it a rent substitution, we can go up to 100%. So if it's a purchase, expansion, or startup, you're looking at 10 to 20% equity in the project. Of course, the startup is seen as more risky, so it's going to be more toward the 20% equity in. I realize I've been talking. Does anybody have questions at this point?
Brad, I think so far everybody's all set. No questions in the queue quite yet. So yeah, everybody just again feel free to drop those questions in, and we'll definitely get to them. So nope, not yet.
All right, we'll keep rolling. So, the SBA can be used for quite a few different reasons. We've talked about the asset purchases. We've talked about the debt refi, but it can be used to buy out a business partner. A lot of times you'll see a situation where two partners are in a business, and for whatever reason, one decides he's ready to retire and cash out, and the other, maybe they want to stick around and continue to run the business. A lot of times we'll provide funds for the remaining partner to buy out the partner who's exiting. We do quite a few business acquisitions as well, where you have owner or owners of a business that are looking to sell and retire, and you have somebody with similar industry experience and wants to purchase the business. We can fund the acquisition of the business. A lot of times in a business purchase, if it's a profitable business, there's going to be a piece called goodwill. It's something you can't collateralize. It's not tangible, but the business, because of its reputation, because of its customer list, it has value. It's producing income. So that's another thing the SBA is able to help the banks get comfortable with, is financing that goodwill piece. We also can do franchise startup purchases. The only caveat there is the franchise has to be on the SBA approved franchise list. That's a pretty extensive list. So most reputable franchises are already on there. That they understand that the SBA is one of the more popular avenues for getting a franchise going. So the franchisors are make sure they get on that list. Well, what can SBA loans not be used for? It's pretty much obvious stuff here. If the business purpose doesn't make sense, that's no go. If it's illegal, can't do it. We can't refinance. You can't refinance debt where the existing lender is in line to take a loss. So it's nothing that's not really obvious here. If it doesn't make sense or it's illegal, you can't do it. Here's a financing example. In this situation, we have a business that's leasing space, or they're going to be leasing space. So they're purchasing $200,000 in equipment. They need $100,000 inventory. They need some leasehold improvement funds. The landlord has provided them a shell, but they need to upfit the space so that it's able to be used for their needs. We put some working capital in. We've also put closing costs. Again, here's that total project number I've been talking about. So you add all that up to give you your total project number. In this situation, the borrower's putting in 15% equity. You got a loan amount of right at $353,000. And because of the asset classes and the uses of funds, we can go up to 10 years on this one, which is a payment of right around $4,500 a month. And if that rate at 9% jumps out at you, that's the market we're in currently. It is kind of strange to see rates where they're at, but these loans are priced off the Wall Street Journal Prime, which is currently 7%. A couple years ago it was at 4%. But the same vein, mortgage rates are around 7%, and we were in the 3s a year ago. So it's just where we're at in the economic cycle.
Right, you're showing the 15% borrower equity. Is that typical? Is it possible to go lower than that, or what is sort of?
I mean, so in this scenario, we could do 10%. We could go as low as 10.
Okay.
I just plugged in 15% here, but no, we could have gone lower and had a higher loan amount for sure.
Okay, gotcha. Yeah, so 10% is possible. Okay.
Yep, and this is just kind of generic scenario. This if it was say maybe a startup business, we probably would be closer to the 15 to 20% equity requirement versus an existing business that's wanting to buy some to kind of expand their operations.
Yeah. I guess more of a technical question. If we were looking at this in terms of a small acquisition, and the seller was going to take financing back, would that be considered part of the borrower's equity, or is that separate?
Great question. And not to muddy the water too much, but so in a business acquisition, the borrower has to put a minimum of 10% in.
Mm-hmm.
With the exception, the only time that the only time that you can deviate from that, if the borrower only has 5% to put in, we would structure it so that there is a seller note for 5% to supplement that could be considered borrower equity.
Mm-hmm.
However, that seller note would have to remain on standby, meaning it could accrue interest, but no payments could be made for the life of the SBA loan.
Wow, for the life of the loan. Okay, that's a
yeah, but
tough
I mean,
sell.
a lot of for a 10-year
Yeah.
note, a lot of borrowers look at it or sellers look at it kind of as an annuity, and usually would structure it 10-5-10 or 5-5-10, meaning the borrower's putting in 5%, the seller's putting in 5% on standby, and the seller's going to have another 10% note that is on payments. So
Okay. And even the
it's-
standby, you said that the interest can be paid on the standby
well,
component?
no, it can accrue. It can't be paid.
It can accrue. Okay. Okay. All right. So, all right.
So
Interesting. I didn't have aware of that.
yeah, in this scenario, at the end of 10 years, the seller would get whatever the 5% plus accrued interest at
Mhm.
once. And there's usually there's something built in so that in the event that the new owner sells the business, of course they can't do it without selling it, paying off the prior owner debt.
Yeah, that makes a lot of sense. That's some pretty interesting options, though. Okay, thank you.
Yeah, it is. So it's possible to get in with a business acquisition for as little as 5%. You just have to have a cooperative seller.
Yep. Yep. Okay.
But we've done it. So the next scenario is very similar to the last one we just looked at. The only real difference here is instead of renting real estate, they're going to be purchasing. So we got 400,000 for the purchase. Everything else is pretty much the same. Borrower equity is still at 15%. However, 15% of the total project, which is going up a good bit. So that equity piece is larger. But what you'll notice here is the monthly payment is 5,300, and we were at the last scenario was right at 4,500. So not a large increase in payment, but that's because we're able to spread all of this out over 25 years versus the 10 years. So that's the main difference. Okay, I thought I had a question here.
Yeah, we have one of our attendees with their hand raised. They haven't got a chance to type it into the queue yet, so I will be keeping an eye on that. So, you guys, if you have any questions at all, just pop them right into either the chat or the Q&A, and I'll make sure Brad gets them.
Yeah, so that's I think that's a good illustration of just kind of the difference. If you can get real estate versus leasing, then it definitely offers a lot more payment flexibility there. So preparing for a loan request, I kind of just put together a list of, whether it's an SBA loan or a commercial loan, just some things to go ahead and prepare for. Don't wait until you decide you need money to start working on this stuff. Do it ahead of that time, and be prepared when you go meet with your lender. The first is credit report. Pull your credit. Do it. Don't let the lender pull your credit before you have. Make sure you know what's on your credit report. You can get at least one free credit report a year. So even if you're not borrowing money, it's good to look at anyway. You would be surprised at how many people have, will pull credit, and they'll be surprised that there's medical collections outstanding. That's pretty common because, maybe you get in an argument with the insurance company as to whose responsibility it is to pay for it. You lose track of it. The insurance doesn't pay. Hospital files a medical collection. That happens a lot. But when that happens, we can't move forward. No bank can move forward until those collections are cleared. So, and also that's an automatic red flag on your file out of the gate. So, I mean, it's easily preventable to go ahead and pull your credit, check it, and if there's anything that needs to be addressed, go ahead and address it. Through, especially after the 2008 recession, you saw a lot of people who went through some tough times, and people do have marks on their credit, and that doesn't mean that that doesn't automatically disqualify you from getting a loan. But go ahead and be proactive. If you've had some credit issues, be able to explain them. I mean, I like, I've had people come to me and recognize that they've had some past credit issues, but they address it out front. I mean, we're going to find out anyway. So if you can go ahead and provide an explanation as to what happened and how it was cured, and kind of see that as a one-time thing. If you can get out in front of it, it always looks better. tax returns, make sure your tax returns are ready. They're going to need to see 3 years of personal and business if they're available. If you're new business, of course, that's not going to be a thing. Personal financial statement, and this is just a list of all of your assets and all of your debts. That's really all that is. The bank will provide you a form, but just go ahead and start gathering that information. And the next two are kind of where SCORE can really come into play and help you. Business plan and projections. If you're a growing business, a new business, this is expected. It's good to have anyway. Having a business plan, know where you want to be in a few years. It really shows the lender that you're on top of things and that you know what's happening. It's an absolute for a new business. For a growing business, it's pretty much an absolute as well. And the financial projections. If you don't have the historical performance, you've got to have projections. But you also need to be able to provide some narrative to support those projections. How do you plan to achieve those revenues? If you're saying you're going to reduce operating costs, how are you going to do it? So again, these are areas that SCORE can really come in to assist you with. So don't hesitate to reach out to them. Next up, know what you need. And by that, what are your costs? We don't just need a budget, but what's real? If you want to buy real estate, what's reasonable? Show that you've done some research and worked with an agent. Know how much per square foot it costs for this type of space you need. If you need to buy equipment, go ahead and get that priced out. Provide some invoices. But have your costs pretty well dialed in. Even down to if you're a new and expanding, what's your payroll going to be for the next 6 months? How much money do you need to operate? So having your arm around your cost is very important. So having all this stuff together when you meet with the lender, the better prepared you can be, the better it looks for you. So just prepare these items best you can. But another point I want to make: most people, or a lot of people, assume this, but some people are surprised. Anytime you get a small business loan, your personal assets are going to be at risk. Ultimately, you're going to be asked to personally guarantee the loan. So that means if you don't pay the loan, first the bank will go against the business and liquidate any business assets. If that doesn't satisfy the debt, then they come to you personally. And if you own real estate, then liens will be filed on your real estate for any deficiency. So it's just good to be aware kind of out of the gate that, your personal assets could come into play if the business isn't successful.
Hey, Brad, just a comment. This is everybody that's attending, this is really a critical slide. So everybody just take note of this. Brad did a really nice job outlining these steps, because we'll get this at SCORE a lot in terms of, the client is sort of ready to start looking at financing. They feel they need some financing to move forward with their business. And these are the steps that we would go through. So you just make note of these. Some of these things, like Brad said, you can start doing pretty easily, pretty readily, getting your credit report. You're pulling your tax returns together. We could help you, but even putting together your personal financial statement, those are things that you probably do to before you even get started. And SCORE can help you with the business plan, the financial projections, and the costs. So just wanted to make that comment.
Thank you, Jerry. Yeah, and just to kind of reiterate that point, what I'm seeing more often these days is that people may have a good business plan and set of projections together, but they don't really have their arm around cost. So that really delays things because it really takes time to really put numbers to the project and decide what it is going to cost. If there's a construction piece, right now construction is very expensive. It's not as bad as it was several months ago, but it's expensive. Many times you're going to have to hire a architect, an engineer. So that a lot of times there's a pretty good cost outlay before you get loan approval. You know, a bank can't make a loan decision if we don't know how much funds are needed. And many times a contractor can't give you a quote on a project if they don't have plans for an architect from an architect. They don't know what they're being asked to quote. You know, a lot of times, you know, I'm seeing architect for a lot of projects, you know, you're in the $20,000 to $30,000 range just to get a set of plans. So, you know, the cost piece is really, really huge. And that's where a lot of people end up spending a lot of their time, is really dialing that part in. That was all I had today. You know, we'll open it up for questions. Again, I'm SBA lender with First Bank. We're a preferred SBA lender. And what that means is that the SBA has essentially vetted us, and we don't have to go to the SBA for approval to do loans. We can originate, approve, service. We can do everything in-house. So we don't have to go to the SBA for their approval, which makes the process a lot more efficient, and it's just a lot easier process to deal with. But my contact, you know, we'll open it for questions here, but anybody on the call, feel free to reach out to me. Here's my contact info. Happy to serve as a resource. If I can't help you, I always like to try to make a connection with somebody who can. So again, hope to hear from some of you soon. So with that, I'll go ahead and open it up for see if anybody has any questions.
Okay, so we have the chat and the Q&A windows open, so we'll just hang in here for a minute or so. If anybody has any additional questions, just drop them right in there. We'll be happy to help you out with those. Brad, I think I just had a couple of slides towards the end here. I don't remember what they are, if you could just go through, but yeah, all right. So if we have any questions, so what's the next one? Yeah, just again, I mentioned this at the beginning of the workshop, and this is how you can go about requesting a mentor and what that's all about. You know, identifying on this slide, and you know, that your information is confidential. We provide the one-on-one attention, and it's really suited right to your situation. You know, and that's you know, just another option for anybody that's working through this and you know, needs some help with their business plan or other aspects of their business. Yeah, so also anybody on the call, if they're ever interested, if you're a small business owner or you're looking to at some point free up some time, we're always looking for additional volunteers. So that's this is sort of our plug here to see if anybody is interested in becoming part of the SCORE team. If so, you go ahead and check out our website. Feel free to reach out to myself. I can tell you more about the workshop and not the workshop program, but also the SCORE in general, what the chapter does, and the other types of volunteer type roles that we have.
Jerry, we did have one question that just popped up.
Okay, let's see. We got it in the Q&A. Okay, this is basically asking what the consequences are of non-payment.
Sure. So in the event of non-payment, and this is kind of, you know, this applies to any loan. You know, the first thing, you know, if the business can't pay, then and they just say we're giving up, we can't pay. I mean, typically the bank will try to work with the business, come up with a payment plan somehow to give them to the point where they can pay. You know, and then if the business just needs to dissolve, then all the business assets are sold to pay down the debt the best it can. And then that's where we start talking about personal liability, is once the business assets are sold, the debt's paid down, any leftover amount, the guarantor, the business owner, will be responsible for personally. So, you know, there's several ways to go there. It could be a payment plan, you know, where the owner comes up with a way to pay the debt off over time. Or it could be if the individual cannot pay, then judgments will be filed against the individual personally. So in that case, that's what we were talking about earlier, where if you own real estate, those judgments will attach to your real estate. Judgments are out there in South Carolina for 10 years. So that's, again, just a point we discussed earlier. I wanted everybody to be aware of kind of going into it as a small business owner who needs to get debt, that personal liability can come into play.
Okay, question from Megan is basically about the ability to lock in interest rates.
Right. Most, pretty much all of the, the 7A loans are variable. So it basically goes up, the rates go up and down with the Wall Street Journal prime rate. So it's usually some premium over Wall Street Journal prime. In an increasing rate environment, which we are in, that gives people some concern. Rates go up, payment goes up. But at the same time, the inverse is true. As rates begin to come down, and when the economy cools off like it always does, and we end up in a recession, rates are brought down to try to stimulate the economy. And at that time, your rate the Wall Street Journal rate follows the Fed funds rate. So it would come down as the Fed brings rates back down. Good question.
Mm-hmm. All right, I think we may have gotten to the end of the questions, Brad. This is just the last slide, just how you can also find us besides our website, some of our social media links, and that'll be in the presentation that you guys will all get a copy of that. And again, to the question, we're going to get a recorded copy of the webinar. Yes, that'll come out in a couple of days. We'll get that over to you guys as well. I just wanted to thank Brad for his time, and I think this was a great succinct layout in terms of what a small business owner would need to know about securing capital. So he covered everything from the whys in terms of why would you need that, the specific needs that are covered, the process that you would, or at least an outline of the process of what you guys would need to go through to start the process. And we're all here to help. So if you've got any questions, Brad has his contact info within the presentation. You can reach out to SCORE, and we'd be happy to assist you guys as well. So with that, just one more peek here, see if we got any other questions. But I think we have wrapped it up, and wanted to thank everybody, and everybody enjoy the rest of the afternoon.
Thank you, Jerry.